Hi everybody, the topic for today's video, we're going to go through bear call spreads and we're going to go through bull put spreads. The two main credit spreads that can help you tremendously in your trading. They predefine your risk, they predefine your reward, and they're great. They're really great to use, but before we dive into those, it's important to understand how to really put these spreads together and what the mechanics really mean. And to understand the mechanics, you first have to understand the long call as well as the long put, and the short call and the short put, essentially. So we'll go over those real briefly, and I'll show you how to construct a good trade on TradeVision and how to set up a credit spread. So let's go ahead and head to the visualizer here. And I'm going to go ahead and type in a ticker that I think most people will most likely know. SPY for the S&P 500, SPDR. Let's begin here. So the essentials of the credit spreads is that we are buying an option and we're selling an option both at the same time. First and foremost, let's select an appropriate expiration date. For credit spreads, you can really select any expiration date you want. Time decay is working for you. Just remember that. Time is working in your favor. So as time gets closer and closer to the expiration date, as the 45 days gets closer and closer, as October 25th approaches, time is working in your favor and can make you money. So we'll begin with the bull put spread, and the bull put spread involves selling put and buying a put both at the same time. Now let's backtrack and let's just look at the long put. So the long put, let's say we selected a $500 strike price for this long put right here. What does that mean? First and foremost, the green means that you're owning the put. So we're going to buy this put from someone else in the market. And if we're the owners of a put, guess what we want the stock price to do? We want the stock price to go down. As soon as the stock price goes down, we end up making money because we own this put. Ideally, we want SPY to go below $500 per share in 45 days by October 25th. If the stock price ends up being somewhere down here in this area, this will be referred to as in the money, abbreviated as ITM. If you bought the $500 put while the stock price is currently trading at 548.79, you bought an out of the money option, also known as OTM. And if the stock price ever approaches, let's say 505, or maybe let's say 501, let's say the stock is at 501, then your option will now be what's referred to as at the money, because it's right there. It's about to be in the money, but it's not in the money just yet. It needs to go down another dollar if it's trading at 501. So make sure you understand the terminology. It's incredibly important. But overall, that's what the long put is, right? We buy the put. We want the stock to go down so that we can make money. Now, what's also important to understand is going to be your delta value of the put option. So the delta will be your rate of change, and it will also be the probability metric that you will associate with, will this put be in the money at expiration? It's incredibly important to understand that. So as we can see right here, we have a delta of negative 10 or 0.106. So understand that if you have a positive delta, you will make money if the stock price goes up. If you have a negative delta, you will make money. If you have a negative delta, you will make money when the stock price goes down. Right? Positive delta, you will make money if the stock goes up. So with the put option, we have a negative delta right here, as you can see. That makes sense, right? It should, because we want the stock to go down if we're buying a put option. The put option will give us the right, but not the obligation, to sell shares at a specified price, which is the strike price. This is the $500 put. If SPY ends up in the money by expiration in 45 days, then we have the right to sell shares of SPY at $500 per share. It's important to understand that. Okay, same thing for a call option. Let's go ahead and head to the long call. Right? So if we're a buyer of a call, if SPY is currently trading at 548.79, it's going to be the exact same thing as a put, but the inverse. Let's say we looked at the 580 call up here. We have a delta of 0.11. Okay. the delta is positive in this case, which means we're going to be making money and the stock goes up, which is what we want, right? You're going to make money if the stock goes up. You want the price of SPY to reach above 580. That will be declared as ITM, or in the money, if the stock price is anywhere above the strike price. If the stock is currently trading at $548.79 and we buy this 580 call, we are now purchasing an out of the money call. And then, of course, if it gets to, let's say, 579, then that will be referred to as at the money right here. Okay? And also the delta will be our rate of change. I think I mentioned earlier. Rate of change 0.112. So if I bought this call option and let's say SPY is currently trading at 548.79, let's say SPY goes to 549.79, it goes up $1. Okay, if SPY goes up $1 to 549.79, I will make approximately 11 cents on the premium. So the current price to purchase this call option is $1.23. Okay, if it's $1.23, and let's say the price of SPY goes from 548.79 to 549.79, I will make approximately 11 cents. So the new value of my call option will be approximately 1.34 if I add 11 cents to it, right? And of course, we always want to multiply this number by 100 to get to the actual dollar value of how much we're spending, because it's a per share basis and each contract controls 100 shares. So this is the basic information that you really want to understand, because when we start working with the spreads here, let's go back to the bull put spread like how we did in the beginning. We're going to be working with two different options. We're going to be selling a put and buying a put both at the same time. So let's say I wanted to set up a bull put spread. Okay, the whole fundamental theory behind the bull put spread is we want the stock price to remain above the strike prices that we've chosen, aka like this. We want SPY to remain above here, anywhere in this area, even up here too. Anywhere in this area above our strike prices we have chosen by the 45-day expiration date. And as long as that happens, then we can collect the maximum profit. So with the bull put spread, let's ignore this one for now. And let's just focus on this red one, the 505 put. We are selling this put. Now, if you remember what we mentioned earlier, when we bought a put, we want the stock to go down. So what's going to happen if I sold the put to someone else? You can think of this as a separate transaction that you're actually making with someone, making with another trader, for example, right? Let's say I sold you the 505 put. If I sold you the 505 put, you're the buyer of the put. So you bought it from me, therefore you think that SPY will go down. You think it's going to go down to $505. If I'm selling it to you, I'm basically telling you, hey, take this put, good luck. I don't think SPY is going to be going down. Therefore, since SPY is not going to be going down, I'm going to keep the premium that you paid me, which in this case, it's going to be $2.74. So you're going to pay me $2.74, and I'm going to keep all that because I don't think SPY is going to go down. You, on the other hand, you're buying this $505 put for $2.74. You think it's going to go down. If the price of SPY continues to go down, the value of your contract will rise by your rate of change, delta right here, 0.123. So if SPY is currently trading at 548.79 and it goes down to 547.79, you will make approximately 12 cents of premium, right? And that's only if you're the owner of the option, right? Let's backtrack and let's go back to square one. We are selling this option in this bull put spread example. So if I were to sell this 505 put right here, all this is, in most simplest terms, is I don't think SPY will go down to 505. Therefore, I'm going to sell it so that I can make money as long as SPY stays anywhere in this area by the expiration date. Now, when you're selling a put, right, ignore this one again. Let's go to the short put because that's the terminology for it. When you just have it by itself, you also have the potential for unlimited loss. Okay, so when we're selling this put by itself, right, if the person who bought this put from me, if SPY actually does come down pretty hard, they can make as much profit as they want as long as it's within the 45 days. What does that mean as a seller? Well, I'll keep their premium that they paid me, But if the trade goes against me, if SPY continues to fall, which is what every put option owner wants, then I have the potential as a seller for unlimited loss. Because whatever profit that they make from that put option, I have to make sure that that money comes out of my account because I have to pay them. They bought the put from me, their put increases in value, I have to make sure that that person gets paid. Again, if that doesn't happen, if SPY stays above 505, then I keep this premium entirely. So as a seller, I can have this. As a seller, the two ideal scenarios is for SPY to go up because that will decrease the probability that the 505 put will become in the money, or I can have it go sideways. That's okay too, right? Or maybe it does go down, but then it doesn't go down far enough. Maybe it just kind of stagnates, kind of does its thing around here, and then maybe it just kind of chills. Next thing you know, 45 days is up. I still collect the premium, and I will end up in a profitable trade because time decay was also in my favor. Even if the stock goes down, time's still ticking. It's like, SPY, are you going to go down to 505 or not, right? Time's ticking, and if not, then as a seller of the put option, I will keep the premium. As the owner of the put option, you want SPY to move downwards. All right, so hopefully that clears the error a little bit, because now let's go back to the bull put spread and let's set up the trade. So the 505 put, as we just discussed, we want to sell this put. We want SPY to remain above the strike price. Now, with the bull put spread, it's nice because we can have protection. Let's just say that SPY actually does come down, which is what we don't want for this one right here. Let's say SPY actually does come down. Well, we can buy this $500 put for protection purposes, right? Because if you're the owner of a put option, guess what? You're going to be making money when the stock goes down. So you'll lose some money on this one because SPY's coming down. You don't want that if you're selling the put option. But you'll make money from this one right here, the $500 put, because you actually own this one, and as SPY comes down, this will increase in value. So this 505 put will control most of your risk because it is more expensive than the 505 put, or excuse me, more expensive than the 500 put. Let's take a look. The 505 put is currently worth $2.74. That's how much premium I will collect. $2.74. The $500 put cost $2.35. Okay, so this number, $2.74, is how much I received, and $2.35 is how much I am spending. So let's take the difference between these. $2.74 minus $2.35. Guess what number that equates to? It should equate to 38 cents approximately, or $38 if you multiply it by 100. I think this is actually 39, but 38 works too. It's about the same thing. Okay, so that's how you find your maximum profit or your net credit. They're both going to be the same thing. How much credit you're receiving from this trade, right? Hopefully that makes sense, right? Because you're selling the 505 put for the $2.74 price, and you're buying the $500 put for $2.35. It's called a spread because as a seller, you will keep the difference. You received this and you bought this, you will keep the difference as long, again, as SPY stays above your strike prices. Now, you have a maximum loss number right here. Where is that coming from? Well, it's very easy to identify that number. You take the width of your spread, which in this case is 505 minus 500. So we have a $5 wide spread. And then we go ahead and subtract our credit that we receive. So we're going to subtract 38 cents and then boom. What does that give us? That should give us $4.62. And if we multiply it by 100, because each contract controls 100 shares, then boom, we get our maximum loss number of $462. So the spreads are actually very, very simple, right? Maybe if you're watching this for the first time, maybe it's still a little difficult to wrap your head around. That's okay. Watch it again because it'll start to make sense. It's very simple. All you're doing is you're selling a put and you're buying a put both at the same time. They're going to work in tandem to provide you a good predefined risk and a predefined reward trade. Again, we're buying this one for protection in case SPY comes down. We're buying this one, or excuse me, we're selling this 505 put because we don't think SPY is going to come down. This one's controlling our risk. This option contract is more expensive because it's closer to the strike price. I understand 548 and 505 is still pretty far from each other, but 505 is a lot closer to 548 than 500 is. Therefore, this is going to be more expensive because it will have an increased chance of hitting the strike price, right? This one's cheaper because there's a decreased chance of the strike price. Now, let's go on to the next step. How can I find out what my chances of probability are? First things first, delta. We discussed delta, that delta will be your rate of change. It's also going to be the probability. Delta equals probability. Okay, so with the 505 put, this has a delta of 0.12, or you can say 12%. What does that mean? Again, it means that the put option has a 12% chance of being in the money by expiration in 45 days. So SPY has approximately a 12% chance at this present moment in time of going to 505 or below. Now, these probabilities and these deltas are always changing. They're always fluctuating just based on what's happening in the market. They're not perfect probabilities, but they're good estimates, and they're rough estimates that you can use to identify which put option should I sell. Right? Which put option should I sell? Because if this one only has a 12% chance, then as a seller, that gives me pretty good odds, right? Because you don't want the stock to come down. So if you sold this one with a really low delta, it has a really low probability of coming down. And that's exactly what you want, because you want SPY to stay up here. So the delta will help you tremendously in identifying which strike prices do you want to sell. It might not be the only factor you can base it on. You can always base it off support resistances, certain indicators, call put walls, like these little green and red bars. There's a lot of different things you can base it off of, but it's a great tool for helping you assist in which strike prices to select. Let's say I go to a 510 put option. I want to sell this one. This one, therefore, has a 14 delta. There's a 14% chance that the stock will come down. So the odds have increased that this will be in the money by expiration because I've selected a higher strike price because it is closer to the current stock price right now, right? Let's say I selected 520. 520 is much closer to 548. Therefore, there's an increased chance that the market actually does come down. What's the delta on this one? 0.19, 19% chance, right? What are the benefits of a higher probability of this being in the money? Well, as a seller, you can collect more premium, right? This option is priced at $4.40. $4.40. Let's say I wanted to do a trade with the 520 put instead. Let's say I wanted to do a 520 and a 510 put. This 510 put costs $3.19, right? 3.19. So I receive $4.40, and then I spend $3.19 for my protection, just in case SPY actually does come down, right? Then I will make some money off this one. That's going to predefine my risk and predefine my reward. I'm going to keep the difference between these two, which should be my net credit up here. $121 or $1.21. Okay, and of course, if you times it by 100, you will get to this number. Again, the maximum loss, if you take the width of your spread, which in this case is these two numbers right here, it's going to be a $10 wide spread. If we take 10 minus the premium we received, which is $1.21, we will end up with $8.79, which will be this one, this maximum loss number right here. Okay, so this is how you can use the spreads to your advantage. This is what we mean. It's going to be the exact same thing for a bear call spread as well. Exact same concepts. Don't let this one confuse you. Okay, again, the bear call spread is just going to be the inverse. You want the stock price to be below the strike prices that you have selected. All the calculations will be the same. Same thing with the deltas. Delta, you want to choose a delta of maybe like 0.10 to 0.2, just so you have high probability that the trade will work out in your favor, right? This is a delta of 16. So this call option has a 16% chance of being in the money by the expiration date of October 25th in 45 days. Roughly, okay? Delta is not perfect, but it's a rough estimate again. So SPY If SPY were to do this, there's a 16% chance of that happening, approximately. Okay, so that's good odds for a seller because it's only 16%. So therefore, you're going to have around an 84% chance, which will be a rough estimate to this number down here. Okay, again, there's a few other little factors that come into play, but the delta is always going to give you that rough estimate. So that's how you can use delta to your advantage and how you can use it to select proper strike prices. Hopefully this helps. Hopefully you found this video useful. Hopefully you understand spreads just a little bit better. They're really great tools for predefining your risk and predefining your reward. And thanks for watching.